All right, today we're going to talk about something that's both powerful and, yeah, pretty risky: margin trading. We are going to break down the two absolute must-know rules of the game. That's initial and maintenance margin, and what they actually mean for anyone looking to, get a little more bang for their buck in the market. Let's dive in. I mean, who hasn't thought about that, right? That feeling that if you just had a little more capital, you could make a really significant move. Well, that's exactly the promise of trading on margin. It's basically a tool that lets you control way more stock than your cash balance would suggest. So, how does that even work? Well, it all starts with something called a margin account. The easiest way to think about it is like a normal brokerage account, but with a built-in line of credit. Your broker is essentially lending you money, and they use the stocks and cash you already have in the account as collateral for that loan. Okay, but you can't just borrow an unlimited amount of money, of course. There are rules. And the very first one you're going to bump into is called the initial margin. This is all about the getting started phase of your trade. To make this super clear, let's just follow one single trade from beginning to end. Imagine you found a stock you really like. You want to buy 1,000 shares, and it's trading at $10 a share. So, simple math, right? The total cost to buy that position is $10,000. Now, in a regular old cash account, you'd need that full 10 grand sitting there, ready to go. But with our margin account, the story is very different. Here in the US, there's a rule from the Fed called Regulation T, and it says you have to put down at least 50% yourself. But, and this is super important, your broker can be even stricter. So for our example, let's say your brokerage has a house rule that you need to put up 65% of the total value yourself. So what does that mean? Well, for that $10,000 trade, you only need to come up with $6,500 of your own money. Your broker lends you the other $3,500, and just like that, you're now controlling $10,000 worth of stock with just $6,500 of your own cash. And that's 65% that the broker required? That is what we call the initial margin. Honestly, the best way to think about it is just like a down payment on a house. It's the skin you have to put in the game to get the trade started. Now, this is why people get so excited about margin. Let's say you were right, and that stock is a huge winner. It doubles from $10 to $20 a share. Suddenly, your position is worth $20,000. You sell, you pay back that $3,500 loan to your broker, and you're left with $16,500. Think about that. The stock went up 100%, but your personal return on your $6,500 was over 150%. That is the incredible power and the seduction of leverage. But as you've probably guessed, leverage is a serious double-edged sword. As soon as you open that trade, a whole new rule kicks in. It's not about getting started anymore. It's all about staying afloat. And that brings us to the maintenance margin. This rule is called the maintenance margin. Think of it as the absolute minimum level of your own money, your equity, that you have to keep in the account at all times. So while the initial margin was kind of there to protect you from getting in over your head, the maintenance margin, well, that's really a safety net for your broker to make sure they get their loan back if your trade starts to go bad. And that, of course, brings us to the other side of the coin. We've seen the dream scenario when the stock goes up. But let's be real. What happens if we were wrong and the stock price starts to tank? Let's go back to our trade. The stock you bought for $10 a share suddenly plummets to just $5. Your position, once worth 10 grand, is now only worth $5,000. But here's the kicker. You still owe the broker that $3,500 loan. That means your own equity in the account has evaporated from $6,500 all the way down to just $1,500. And this is where things get really dicey. Because that massive drop in your personal equity, well, it triggers what is probably the single most stressful event for anyone trading on margin. It's a moment that forces you to make tough choices, and you have to make them fast. It's called a margin call. Let's say your broker's maintenance margin was 30%. With your equity at $1,500 on a $5,000 position, you are right on that 30% line. If that stock drops even another penny, your equity percentage will dip below 30%, and you will get a notification from your broker demanding that you fix the problem, and fix it now. So when you get that dreaded call, you've got a few options, and honestly, none of them are great. You can wire in more cash to bring your equity back up. You could deposit other stocks or bonds you own to add more collateral, Or, and this is what usually happens, the broker forces you to sell some of your shares at that rock bottom price to pay down your loan. This crystallizes your loss. It's brutal. Okay, so now that we've seen the thrilling highs and the stomach-turning lows, let's just put these two ideas, initial and maintenance margin, right next to each other to really make sure we get it. Then we can see how margin stacks up against some other ways to get leverage. So let's make this perfectly clear. Initial margin is all about starting a trade. It's a one-time check when you hit buy. Maintenance margin is about holding that trade. It's a constant, ongoing requirement. The percentages are different, usually 50% or more for initial and more like 25 to 40% for maintenance. And fundamentally, they protect different people. You could say initial margin protects you from taking on too much risk at the start, while maintenance margin is all about protecting the broker from your trade going completely bust. And, it's worth knowing that borrowing from your broker isn't the only way to get leverage. You have things like leveraged ETFs that can give you 2 or 3 times the market's movement. A huge plus, no margin calls, but they have their own quirks with daily resets. You also have call options, which can give you massive leverage with a fixed, known risk. Both of these are complex in their own right. And like a margin account, options trading definitely requires special approval from your broker. So if you're going to walk away remembering just a few things, let it be these. First, margin is a magnifier, full stop. It makes your good days great and your bad days absolutely terrible. Second, initial margin is the down payment to get in the door. Maintenance margin is the minimum balance you need to stay in the game. Fall below that, and you're getting that dreaded margin call. And maybe the most important takeaway of all is that margin trading is not a buy and hold strategy. It forces you, whether you like it or not, to become a very active risk manager. Look, there's no doubt it's a powerful tool, but it's one that requires constant vigilance and a really steady hand when things get stressful. So the real question isn't just about the math, it's about you. Does that kind of high-stakes, hands-on investing actually fit with your own financial goals? And more importantly, your own personality and tolerance for risk? That's something only you can answer.